another episode of Commercial Property Roadshow. You're here with Helen Tarrant, and what I'm going to share with you today is the 10 tips for getting started in commercial property investing. Now, they talk about how in commercial it's very different from residential, that it's all about tenant, tenant, tenant. Well, I'm going to tell you there's a lot more surrounding the magical thing about tenants, right? So I've listed 9 other factors that I'm going to give you tips on for when you start out in a commercial property journey. And this is crucial because if you get any one of these wrong, you are going to be up for thousands of dollars. And this is why you need someone like me in your corner. So let's start out. Tenants. Why they're so important? Well, tenants are so important in your commercial property because they give you passive income. They pay you rent, you pay the bank, and the rest is for you to keep. And that's how simple it is to make money in commercial property when you're buying a set and forget property. So the most important thing to do when you start out and you're looking at investing in commercial property is to, number 1, understand your tenants. Who they are, what do they do, where are they located, are they just one shop, are there many shops, are they a franchise, are they expanding? Who and what do your tenants do? So Google reviews, stalk your tenants a little bit, check out their services, utilize their services if you can, talk to them. So we do all of that as part of our DD, try to understand who the tenant is. So number 1, understand your tenant, but don't get stuck on your tenants, because if you say I only want to do medical, that's going to be a 4 to 5% yield. So you got to be flexible. I'm not saying getting fixated on the tenant. I'm just saying know your tenant. Number 1. Number 2. Understand market cycle, right? Market cycle, where are you in that market cycle? So in the residential space, we talk about the property clock. In commercial, property clocks don't really exist, but they have what we call the tenant tier, or what I've invented as the tenant tier, which talks about the different levels of tenant and the type of returns. But what market cycle talks about is where is everybody else at in the actual area you're buying into. So you might find certain areas are going from everyone's going on a 3-year lease at the moment, or it might be a cycle at the moment that you might see cafes only taking 1-year leases with 1-year options. And that the reason for that is that, there's no confidence in the market. But you might also see that government NDIS tenants are on 2-year rolling leases because they are also based on funding. So where are they in the market cycle? They're coming out of their 2-year lease, waiting for the next funding to happen. Where is this market in that little micro area is happening? So are you getting a spike at the moment where there's less vacancies in retail, less vacancies in office space, or less vacancies in the warehouse? And because of that, how is that going to affect the rent that your tenant is going to pay? So it directly links to your tenant. So know your market cycle. Number 2, know your market cycle. Location. Number 3, understand your location. Understand the pros and cons of your location. Nothing is 100%. You got to know what's your pros, what's your cons of your location, how that affects your tenant, and how you're going to re-tenant in the future should your current tenant leave as well. Number 4, we're going to talk about yield. Yield is a return. Yield is return on the money you put into the property and what the rent the tenant's paying indirectly to the purchase price. Now, yield is not everything, even though a lot of us chase yields and returns in the commercial property space. It is by far not everything, because it's directly related to the type of tenant, the location, the market cycle, and everything else here on this table. But yield, with more yield, more risk, less yield, less risk, right? So in this sense, what you're going to see is that you're going to see that you have to find the appropriate yield for the type of tenants that you have, right? Now, property type. Property type is your 5th thing. Property type. Does the property type match your tenants, right? Property type. Is it versatile? Is it going to let you put a new tenant in there? How much fit out do you need? Is it a good location? Is it a property type suitable for the area and the type of tenant you want to attract? So property type as well. Versatility is really important. Can you go from a dentist to a barber to a cafe to a government tenant, right? Is your premise going to be that versatile? So find versatility in your premise, or find an exit strategy that you can use if your tenant does end up leaving. Capital works. This is all part of your DD, but going it with eyes wide open is always the best way to do any deal, whether it's commercial or residential. And the reason for that is eyes wide open, capital works, right? How much capital works is there, right? Is it immediate? 12 months, 24 months, or 5 or 10 years down the track. 5 or 10 years down the track, you just amortize it and build it in. It's not a deal breaker. And the reason for that is because, you know, the rise of your tenant's rent, the rise of your capital gains, you just got to amortize. It's kind of a maintenance. Like if you have a residential, you're going to maintain it. Have a commercial, you're going to maintain it. So, right, capital works. There's nothing that is going to kill you in the next 12 to 24 months. Then it's not a deal breaker, but it's about how you treat that. You know, you don't want a $50,000 roof repair to come in, you know, year 2, but if it comes in year 7, then you can prepare for something like that. Rent. Understand market rent. Why is understanding market rent so important? Well, do you know if your tenant's paying on market, below market? Is there a way to adjust the rent? Or maybe they've got incentives that's built in already. Maybe their rent is higher because they're paying for they're paying for some outgoings as part of the gross rent. Or maybe they're paying, you know, net rent, but they're paying higher rent because they've had a fit out done and they're amortizing that as well. So understand how your rent is made up and understand that what your tenant's paying for, what you're paying for, so that you are crystal clear when you're going in and you're liaising with your tenant as well. Future potential of the property. Do you want future potential or not? That's actually one of the key questions. Do you pay for future potential? Do you not pay for future potential? That's really important because some people, if you buy a development site, you're absolutely paying for future potential, right? If you are buying a site that has natural capital growth or in a really key area capital growth, that is also future potential. People are paying the right yield for it. But if you are also buying a property that you actually want to develop, or you know you're going to knock it down, or you know that you're only going to keep it for 3 years or 5 years and then knock it down, then that is a different future potential because it's not something you can gain straight away, and you got to make a decision. Do you pay for that future potential, or do you don't pay for that future potential and you just let it happen, right? And finally, due diligence. Again, going into the market, going into your deal with eyes wide open. Understanding due diligence, understanding what you need to do. Each and every property is different. Every tenant is different. When you do a franchise tenant, it's different because you're going to try to look at the franchise agreement, try to understand how much they're paying, understand their fit out, understand the rent they're paying, always going to sit above market. Medical tenant is going to be different. Retail tenant is going to be different. Every one of these tenants have a different quirk, right? And you have to understand how the due diligence is done for different type of properties, different kind of markets, and how hard you can push in different markets. We're in a seller's market. You can't push very hard with your deals because if you do, they're just going to walk away and find someone else, right? There is a level where you can push each and every one of these deals, and sometimes that's determined on all of these factors adding in. And that's why these are 10 tips for you to get started in investing in commercial property. So let's recap. Number 1, market cycle. Know your market cycle. Well, number 1, which is related to the tenant, which should be number 1, but market cycle, right? Number 2, location. Pros and cons of your location. Understand the pros and cons of your location. Number 3, yield is not everything. And with more yield, more risk. Less yield, less risk. So yield is not everything. Property type. Know what property type you have, what you're looking for, understand why you need to find properties of that type that is interesting to you. Versatility. Find versatility and exit strategy in your property so that you can always safeguard yourself. Capital works. Eyes wide open, understanding how much capital works, whether it's a deal breaker or not. Work out what you need to pay in the next 12 to 24 months and amortize the rest. Because there's always going to be maintenance, and upkeep your maintenance on your commercial property. Rent, know who's paying what, who's paying outgoings, who's not, who is paying a higher rent, a lower rent, understand your tenant paying above market rent or below market rent. Really understand the type of rent in comparison to everything else your tenant is paying is important, and making sure that it connects right to what your tenant can afford is really important about your tenant having longevity. Finally, we're looking at future potential and due diligence. Future potential, should you pay for future potential right now? Is it a development site? Is it not? Do you want to pay for future potential now, or do you pay for security now? What is it that is most important? Understand what future potential is for you, and also that comes in with what's your exit strategy. Due diligence. Due diligence varies with each and every tenant and property type, so make sure you understand the tenant, understand the type of due diligence you need to do. Understand that you can't push hard. It's about a win-win situation with your vendor and yourself. And finally, going through the process and ticking off everything for your due diligence so that you know that you're buying a secure investment. Finally, after all of these 9 things, the 10th thing, which should be number 1, that we talked about before, is the tenant. Everything is related to your tenant. Understand, know your tenant, have empathy for your tenant, work together with your tenant to achieve future success. Your tenant is your partner in the success of your commercial property. Do not underestimate that, and make sure that you fully understand what your tenant do, empathize with their issues, and be the best landlord you can be. Because if you screw your tenant over, you will end up with a vacant space, and all the other agents will know, and they'll find it hard for you to re-tenant. So be warned that karma do come back to you. So all those 10 things, they're going to help you make a better commercial property decision. But if you need someone to handhold you and tell you which one and how the process should be, reach out to me, helentarrant.com or helen@commercialpropertycashflow.com.au. Let's jump on a strategy session. I can walk you through what you should be doing, what you shouldn't be, what you should be avoiding, and the type of property you should be investing in this current market. In the meantime, keep hunting, keep searching, hit the bell, subscribe, and I'll see you at the next video.